start talking about stop losses and limit orders and why they're so important. In fact, they are more important in most cases than your strategies. Finding entry and exit points, using the proper stop losses, getting in the market correctly is more important than any of those filter systems, strategy systems. You've made your decision to trade, but now that's where the game begins. Once you enter the market and how you exit the market is the entire Sunday game. Football, you practice all week, you scrimmage all week, you do all your research and everything else. But when you hit that field, all that counts is from that kickoff ball to the end of the game. That's it. That is what is so involved. And too many traders spend their time building these complex, involved strategies just to figure out when to kick that first ball. Now, in today's class, I'm going to use the term security, but I might say the euro or Facebook or Bitcoin, but I'm not referring to any specific asset. I'm talking about all publicly traded financial assets. I also intermix the terms investing and trading. We know the difference, but it gets very tired saying trading, trading, trading. So let's talk about the art of entry and exits, limits and stops. So when's the best time to enter a trade? That is one of the most important questions anybody could ask. And if we knew the answer to that question, Forex trading would be a lot easier. Unfortunately, the difference between profits and losses is your entry and your exit strategy. For example, you might estimate that the value of a currency pair will appreciate, but if you hesitate to enter into a trade, you may be limiting your profit, or maybe you're entering too early and could have gotten in for a lower price. So typically, finding an entry point starts with solid technical analysis and a plan of action. Now, the most important part of anybody's trading plan is it's always centered around your strategy, but you also need to have part of your strategy, your risk management, and how you will enter a trade and how you will exit a trade and what you will do in between. Maybe using a trailing stop loss, maybe when the markets quiver, getting out of your position. Maybe if the markets soar up, you sell half of your position, move your stop loss up close and let it ride. All of these are different strategies, different ideas. You've got to decide what you want to do before you ever make a trade. So finding an entry and exit point for your trade is one of the most important skills to master. So these quick tips will help you determine when to enter at the best possible price, enabling you to capture more profit. Now, before I go on a little bit, if you look on your screen, there are two handouts I put together for you. One is called Forex Order Types, Entries and Stops. It's just really a summary of this class with everything in all your notes so you can recall everything we talked about. And also, I've given you the technical analysis guide from investing.com. It's a great resource guide. It's not just a little page, it's a big guide on all technical analysis. Now, they are only available in the live class. There's nothing you have to sign up for, no passwords, nothing you have to pay for. Just click the download button. They'll be downloaded. One's a PDF, the other's a Word document. They'll be downloaded to whatever device you're using now. You can move them around later, but you can only get them in this live class. So here are a few tips for entering trades at the best possible times. Now, this is the case where the trend or the trend lines are your friend. Trend lines are extremely useful for day traders, and they can provide fast insight into possible entry points. Essentially, trend lines connect a series of higher highs or a series of lower lows, and they're extremely easy to use. They provide a clear indicator of the support levels and the resistance levels for a specific currency pair. Entries can be determined based on the value's relation to the support and resistance levels. As the value reaches the trend line, it's a good indicator that it might be time to enter a trade. So let me pop up a live chart. I think I have one put together for you in a live chart here. Okay, so let's put a trend line quickly on this chart. Okay, so now we have a trend line. I have multiple hits, 1, 2, 3, 4, 4 hits, so that gives me a valid trend line. Now we see price has been accumulating in a sideways action. It finally started moving into an uptrend. We saw it break out of its support and resistance level right here. It held, though it didn't go much farther. So now what we're looking for is either a pullback, so price can come back down, or a breakout going upward. Now we have to decide what to do and where to enter the market. Well, if price continues its pullback, we might want to enter on this trend line. If price continues to move up, we might use that trend line to figure out where we would enter. That's only a simple example. Again here. Let's get rid of. Okay. Again, we have our trend line. We have our support and resistance levels. We're still waiting for some type of confirmation. We haven't done anything. And in this case, we're using Fibonacci levels. But we need to be able to determine when we want to enter the market. Okay, what price will give us the right price for jumping into a trade? So the first we want to do is analyze the market and identify the trend. Research, learn, and understand what are the relevant correlation factors that are affecting the market. When trading Forex pairs, the first step is to understand what moves the various currencies. After learning about the forces pressuring a Forex pair, you will get to know, or you want to look at a specific asset. So forces include interest rate changes that can push up a currency price, up or down, geopolitical factors like war, political unease, or oversupply and demand of a common commodity like oil. Too much inventory also increases prices, as well as natural disasters and natural supply and demand. So what do? We've decided we want to buy. We want to go long. Okay. We figured out a price along our trend line and a support and resistance level that we would consider entering the market. Well, too many of us use what we call market orders. You wait for the price to reach you. You say, okay, I'll buy now. And you click on open or, a buy order, and it generates your buy at the most advantageous price at the moment. Well, I've never done a buy order a market order that I can remember. I never trade without a limit order because I want to get in the market at the best possible price and better than what it is right now. So limit orders give us the best pricing. Limit orders, which let traders enter trades at specific values and ensure you enter the trade at the best possible value. So here's an example. The euro US dollar is trading at 112.25. And you believe the price will dip slightly before trending back up. You set a trade order at 112. Okay, now remember, it's trading at 112.25. That's the point you expect the price to drop before rallying to ensure you will enter the trade nearest the bottom of the trend. Now, you're never going to get the very bottom, but there are some logical points that you can use a trend line for. Say, okay, I'm willing to enter the order when it hits this trend line, or when it hits that resistance, or when it hits that support level, okay, which is lower than where it is at the current market. So that means automatically you're still making the same trade, but you're automatically getting in 25 pips earlier. Now, with the speed at which day trading occurs, this Forex strategy is extremely useful for locking in the best possible price. Limit orders are orders to purchase or sell a pair of a specific price at a price or better, and they can be requested via the platform. You just simply click in limit order. Instead of leaving market, you click on limit, and you enter the price on which you're willing to enter that trade. And it'll sit there and it'll execute the trade when that price is reached. For instance, a take profit setup will allow you to get in your profit from a trade at a predetermined level, say a 10% profit. A limit order is also the reverse order. So say you see the euro at that 112.25, you decide you want to buy it at 112, you decide you're going to sell it at 113. Well, you can put in a predetermined take profit order, which is technically a reverse order or a limit order, to close your trade when it reaches that specific price. Now, those can be changed continuously, whether the trade has been executed or not executed. You also want to place a stop loss to close your position if the market moves against you. And a stop loss is a limit order in the opposite direction that says if the price drops below this level, in this case, we had done a buy order, drops below this level, close out my position. Again, a stop limit order can be changed anytime you wish. But it's important, it protects you from loss. And it is part of your risk reward calculation, because when you're calculating your risk reward ratio to enter a trade, you should already know your target price and your stop loss price and your entry price, because you can't calculate your risk reward ratio without it. Now, too many people do those three things, push the button and walk away. And remember, you can move your limit orders and you can move your stop loss at any time. You can flip it from a stop loss to a trailing stop loss. One of the great things, if the market moves in your direction, moves well above your entry point, you can change it to a trailing stop loss so you're locked in that profit as it goes up and up and up. And if you put a trailing stop loss, say 10 pips below price, it'll keep moving up. When the market turns against you, it's not going to move down, and it'll execute your stop loss, and you would have moved your stop loss into profit anyway, or a trailing stop loss would have moved you into profit anyway. I don't like to open a trade with a trailing stop loss, but once it's executed moving, I will flip over to a trailing stop loss. Now remember, the peak of the foreign exchange market is during the US-London overlap, and the amount of noise in the market is high. That's why, particularly for long-term Forex trades, it's ideal to place entries at the end of each day. Although this might lead to overnight risk for a day trader, it ensures that prices will be most stable and the trends may very likely be clear. Remember, the markets cause a lot of volatility in specific hours. Now, if you want to trade that volatility, that's one thing. But if you're looking to enter a trade because you think the euro is going to continue up, but you don't want that volatility, maybe you should look for an hour or time in which you're willing to enter that trade. Because once all the economic data has come out in the US and the London sessions are slowing down, the markets get a lot slower. The asset will still move in this direction, but it won't have all that noise in between. Now, also, we have the use of technical indicators. Technical indicators are preset statistical studies that provide you with crucial information about the market and Forex pairs. It will help you set entry and exit points and understand supply and demand and possible swings among other data. So you can create trading signals for yourself using one or more indicators. This will define exactly when to enter or exit a trade. If you want to really step up your game, it's worth learning about the key indicators, and these include moving averages, Bollinger Bands, and MACD. Remember that no two positions are alike, so you can never entirely predict an outcome. Entry and exit points and references will also vary depending on the trader, his strategy, and his style. So the best option is to find a trading strategy that fits with you and then choose entry and exit triggers that are in line with your plan. Because remember, you don't enter the great game until you've actually entered a trade. Then it comes all along monitoring your trade, your stop loss strategies, and what you're going to do in between. So let me share with you. Actually, it's a presentation that was done in the US by Ameritrade. I've edited it down for you, but it's a very good explanation and presentation on understanding orders.
Simply put, order types are instructions to your broker about how to execute your trade. You don't need to know the complicated jargon or hand signals traders used to use on the floor of the New York Stock Exchange, but you should understand the basic order types and how they affect your trade. Let's focus on the basics of how an order is placed. Then, 3 common order types: market orders, limit orders, and stop orders. First up, how an order is placed. When you select buy or sell, your order is sent to your broker, who attempts to fill it on the market. Prices can change constantly, and the system for routing orders has lots of moving parts, all of which impact how quickly and at what price your order is actually filled. Using the right order type can impact these factors and make a big difference in whether your trade works the way you intended. So it's important to understand the main order types. Let's start with market order. This order type indicates that you want your order filled immediately at the next available price. If prices are changing rapidly, the next available price could be different than the price quoted when you initially placed the order. Investors who use market orders tend to be more concerned about the speed of a trade than the price. The lack of restriction on price means this order type has the best chance of being filled, but it also has the risk of being filled at a different price. For example, say an investor places an order to sell a stock at $75, but if the price is plummeting and other investors are also trying to sell, the price could drop by the time the order is filled. Likewise, if an investor places a market order after hours, the price could be very different when the order is filled at market open. Because of this, investors typically use market orders during trading hours and in highly liquid markets. This increases the chances of getting an order filled closer to the requested price. If your priority is to buy or sell at an exact price or better, you may want to use a limit order instead. With a limit order, you specify a price, and the order won't be filled until the stock can be bought or sold at that price or better. However, because of the price restriction, there's no guarantee the order will be filled quickly or at all. Investors generally use limit orders when they have a target entry or exit price and are willing to wait for the market to move in their favor. Let's say, for example, that a stock is currently trading at $55, but an investor believes it'd be a good value at $50 or less. This investor could place a limit order to buy the stock at $50. If the stock never reaches the limit price, the order would never be filled. If the stock does drop to $50 or below, with enough volume available at that price, the order will fill and the investor will buy the stock for $50 or less. The last order type is a stop order, which is actually just a market or limit order with an activation price that triggers the order. When the stock reaches the activation price, the order is executed according to its order type. Stop orders can be used in various ways. Investors can use buy stop orders to buy securities when they reach the activation price, or they can use sell stop orders when trying to limit potential loss in an investment. For example, an investor might set a sell stop order on a stock she owns, specifying that if the stock falls to a certain price or lower, it'll trigger an order to sell the stock at the next available market price. This could possibly prevent more serious losses by getting out before the stock falls too far. There are 3 types of stop orders: stop market, stop limit, and trailing stop. If the investor in this example uses a stop market order, when the trigger price or lower is reached, an order will be placed to sell the stock at the next available price. The benefit is that a stop market order may help get the investor out of the falling position quickly. The risk is that the next available price could be lower than what the investor anticipated. If the investor uses a stop limit order, when the stock falls to the stop price, it'll trigger an order that seeks to fill at the limit price or better. A potential benefit is being able to control what price the stock is sold at, but there's also a risk of the stock falling so quickly that the stop is triggered, but the limit order is never filled because the stock has fallen below the limit price. Investors can also use a trailing stop order. With a trailing stop order, instead of setting a specific activation price, you set a trailing amount or a certain dollar amount or percentage away from the market price. On a long position, you typically set a trailing stop below the market price in an attempt to lock in profits as the stock rises. So let's say you own a stock trading at $100 and place a trailing stop order $5 below the current price. If the stock price increases to $110, the stop price would rise from $95 to $105, staying $5 below the market price. But if the stock were to start slipping, the trailing price would stay at $105, minimizing your potential loss on the position. Each order type has its advantages and disadvantages. Investors should plan ahead and decide which type of order is right for each scenario.
So a significant amount of, let me get my screen back here. A significant amount of experts in trading will agree that psychology plays a major component in trading. In other words, your success as a trader depends a lot on your mindset. Understanding this, it's logical to conclude that you think about your trades will have a majority of the impact on your profitability. So the more effort, the more mindset, the more everything you put into trade, the more likely you're going to increase your profitability. The more accurate you can make your entry and exit points, the more winners you will likely draw, and the more effective your Forex trading system will be in meeting your objectives. Your goal for entries and exits is to add as many winning trades into the draw as possible, or to add in tickets that, when you do pull them, give you a better chance of hitting the jackpot. And I hate talking about gambling and guessing, but once you've entered that trade, once you've entered that great game, okay, you need to get in at the best possible price, okay? Because there is no guarantee. In fact, the odds are that the trade will not do what you expect. And the odds, what you need to do is find a way to minimize your risk and your losses at all times, so that when your profitable trades make profit and offset those small minimal risks, those small risks that you had before, you come out with a net profit. Because believe me, nobody trades at 50% or better. Okay. But when you hit that jackpot and you have that trade that soared up from $100 to 150, or say, to 115, okay, and you pick up $15 per share and you're sitting on 1,000 shares, so you picked up $15,000, but you had 20 losing trades up before that, but each one you lost $200, so you're down $200 on 20 trades, you're down $4,000, offset with a $15,000 profit. You're very happy. So building a trading system is like building a house. When you construct a house, you decide how many rooms it will have, the layout, how many floors, and so on. These decisions are based on your needs, your objectives, your budget, which in this case is your trading capital, and what suits your personality, your psychology. So your needs: husband and wife, 2 kids, expecting a couple more before and so you're not going to buy or build a 2-bedroom house. You're not going to build a 3-bedroom because you need ultimately 5. Similarly, when you develop your entry and exit rules for your trading system, you choose things like risk reward ratios, win rate, and the number of trades over a risk reward over time. A risk reward ratio filter for your trades should always be incorporated. Entry and exits should never exist independent of each other. Okay. Too many people, okay, I'm going to enter my trade at this price. Okay, I'm going to make this trade. I'm going to buy this asset going up, and I'm going to buy it at this price. But they don't think about their exit strategy. Okay, I'll put a stop loss. Okay, that's not a strategy. That's a protection against risk. Okay, what is your exit strategy? When it moves up, you're going to have a trailing stop loss. When it moves up 10 points in your favor, you're going to sell off half of your asset, keep the other half, and move your stop loss up closer. What are you going to do? So first, you determine your risk reward ratio. You determine this by working out your initial stop and profit objectives. For example, if you were going to risk $1 to make three, you would have a risk reward of 3 to 1. And then we have our entries. For the sake of system development, we'll assign some entries as reentries. Reentries occur in two circumstances. The initial entry is stopped out, but the setup conditions still exist. A breakout fails and then goes back within a range before attempting to break out. So in other words, you made a trade, didn't do exactly what you thought. You had a small loss and stopped out, but everything was still copacetic with what you thought. So you entered the market again because now, it resupported the break and you want to go back in the market. So the initial entry is successful and you get a new setup that you want to take. You enter on a breakout and the market starts to trend. You then get the chance to add an additional position at a pullback of a trend. Now, how many of you actually think about adding second and third buys into your current trade? You bought 100,000 euro at 112. Okay. You thought it was going to go to 113. It was at 112.25 and you bought 100,000 euros. You maxed out your leverage. It went up to 112.25. Do you think about, you know what? I'm going to add on 50% more to my trade. What point do you do that? So the trick of using re-entries is in a planning. If you have just had a losing trade and already in a profitable position, it can change your psychology and cause you to make mistakes. So you need to plan this out ahead of time. Developing an entry strategy. There are several factors you need to consider when developing an entry strategy. Why the trade entry is more important than the exit. The very act of deciding to open a trade is extremely important. If you are not in the right frame of mind and you don't stick with your plan, it's very likely that you will end up with a losing trade. This can be overlooked when we examine the results of purely mechanical backtests. So deciding to put your money on the line all starts with your psychological state at the time the trade is entered, the time you jump into the great game. Of course, this is not the case if you have a purely mathematical trading system. But for traders who manually enter trades, the psychological aspect cannot be ignored. When you have a good entry, your probability of success goes up significantly. Your risk management is also very important. So how do you accurately determine when to enter? Entry strategies that make it easy. Simple entry techniques work the best. They allow you to focus on managing your trade once you enter, rather than interpreting a jumble of indicators to work out the best time to buy. The setup. A setup is a condition you watch for prior to entering your position. Once your setup occurs, then you move into your stalking mode. This is when you're looking for that entry point, that high quality entry. Now you become the hunter, spear in hand, pursuing a high quality entry with dogged determination. You're face to face with the markets, unwavering while you wait for the perfect moment to strike. When the time comes, you execute. Your supreme skill ensuring that you net your target with ease. Typically, you will look to drop to a lower time frame from your setup to improve the risk-reward ratio. You could then employ technical analysis such as candlestick analysis for the actual entry. So simple entries that work. For example, on the USD Canadian dollar trade, you could go to a lower time frame. You would see a strong, see in this chart up here, you would see a strong reversal pattern that will get you in earlier and improve your trading risk reward ratio. Entry methods that work. Almost all entry methods work, but they work differently depending on your setup, psychology, objectives, and market type. So candlestick patterns give you a great entry. Indicator crossovers are popular for simplicity. They give you a good point in which to enter. Okay? Not necessarily make your decision. You've already made your decision. Entry points are not required until you've made your decision to buy or sell or not enter a market. Now you've made your decision, you want to buy or you want to go long. Now you need that right point in which to enter. A breakout is a great way to find an entry point. Okay, and now we come to, we're in the market. We've entered, and we've already put the choices of our entry point behind us. So remember, we have to wait for our setup conditions. We have to drop to a lower time frame, apply our chosen method, and check our risk reward ratio. So once you have entered, the real trading actually begins. This is where the work actually takes place, because this is where you make the profit. Do you know when to leave? We all know that there are two steps in every trade: when we open a position and then when we close. But we very often get focused on the first part, often to the exclusion of the second. So there's two parts to every trade. Here's the thing though, you don't make any money by opening a trade. That's actually when you put your money at risk. So when you think about it, opening a position puts you at risk. Closing a position puts you at profit. Whether or not you make money actually depends on when you close your trade. You could open trades at the perfect time, but you won't see a cent of profit from it unless you close the trade at the right time. When you close your trades is your exit strategy, and it's not just as important as where you open your trade. Another possibility is that you could use one strategy to determine entry points and another to determine exits. This leaves you with an unbalanced risk, since each strategy will have a different relative risk. However, closing a trade is different from opening one, which means that the kind of risk you are taking when deciding to close is different. An open trade has the option of losing out on potential profit by closing before the market is turned. So there's a vital difference between a trader who has an exact exit plan and none at all. It doesn't matter if the positions aren't in profit or going down in flames. As a trader, you really need two exit strategies, one to handle profits and another to handle losses. And when dealing with profits, you also need to know how to protect them. So exit planning covers a stop loss strategy to get you out of the market or get you out of winning trades as well as losing trades. So it is easy to get into the market. There are so many different techniques, but what about getting out? There's a vital difference between a trader who has an exact exit plan and none at all. And I bet you 90% of the people sitting out there have no exit plan, have no strategy. You haven't, before you enter your trade, you haven't figured out your possible exit scenarios. Okay. You know, most traders don't. I have different exit scenarios that I apply. Like I said, price moves up 10%. I move as trailing stop loss. I sell half my position, keep the other half open to this difference, sell 25% of that position, move the trailing stop loss up. Those are nice, easy, profitable trades. But how do I turn that move in my favor to the most profitable as well as reducing my risk every step of the way? Therefore, exit planning covers a stop loss strategy to get out of bad trades, a profit protection strategy to exit winning trades, and another strategy to save your neck in case of unexpected risks. You need all three tactics in every trade because anything can happen once you hit the button, the order button. Traders focus a lot of their energy on spotting the perfect time to enter. While this is important, it's ultimately where traders choose to exit trades that will determine how successful the trader is. So there's only two ways to get in the market, with loss or with profit. So a take profit order is also a limit order, or it's what you enter when you open your trade, because you've set your risk reward ratio, stop loss, entry, take profit. And now our platforms have made it really easy. You do this all in one ticket at one time simultaneously. So let me share with you a little presentation on stop losses that will help you better determine where to put them.
you should be familiar that moving average is something that you can use to trail your stop loss, right? So for example, let's say you went long on the break of this highs over here, market break above this highs over here, and you can trail your stop loss using this moving average. This is the 20 period moving average. So you only exit the trade when the price breaks and close below it. Okay, so in this case, you would exit your trade over here when the price breaks and close below the 20 period moving average. The benefit of using moving average is it's
I'm sorry, there was something wrong with the volume or the speed of the playback. So I'm sorry, I'll go over it in words. So trailing stop order is set to trigger at a fixed amount of pips or a determined percentage below the market price. A trailing stop is dynamic as it changes in the position as it moves in the favor of the trade, but remains static when the market comes against the position. Although stop losses in this kind of order you never want to execute, you should include it along with your profit taking in your strategies. It helps lock in profit while limiting potential losses. For a scaling exit approach, raise your stop to break even as soon as the new trade moves into profit. This can build confidence because you now have a free trade. So in other words, so you're at 112.25. We put our entry order, our limit order at 112. It's triggered, it's executed. Our stop loss was at 111.50. The trade moves to 112.25, back where it was before we set up the trade. What do we do now? We move that stop loss up to the 112 because that's a free trade. No matter what happens at this point, we cannot lose money. Well, that gives you a very good sense of safety. Then sit back and let it run until it reaches 75% of the distance between the risk and the reward ratios. So in other words, we entered at 112. We thought we'd get out at it would go out at 113. We're at 125. So when it hits 112.75, we would take our next step. You then have the option to exit all at once or in pieces. The decision tracks position size as well as the strategy being employed. For example, it makes no sense to break a small trade in even smaller parts. So if it's more effective to seek the most opportune moment to dump the entire stake, but it depends on how big you are trading. Larger positions benefit from a tiered exit strategy, exiting 1/3 at 75% of the trade difference and the second third at the target, placing a trailing stop behind the third piece after it exceeds the target, using the level as the rock bottom exit if your position turns south. Because each time you've moved up and sold off part of your position, you've moved your trailing stop loss. So you're farther and farther in profit. And even if the market collapses and turns against you, you're still getting closed out well in the profit. Over time, you'll find this third piece is a lifesaver, often generating a substantial profit. So what happens is market moves up. You're in limit. You've sold off half of your position. You moved your stop loss. Moved up a little farther, sold off 25% more, moved your stop loss. Sometimes that market, for some reason, surges. You've kept that 25%, and for some reason, it surges 30 points, 40 points. Well, you know what? You still made profit on that 25% of your value, your initial order, and that's it's just adding to your chips on your table. So it has been long known that a moving average can be an effective tool to filter the direction of a currency pair has trended. The basic idea is that traders look for buying opportunities when the price is above a moving average and looking for selling opportunities when the price is below. However, it can be useful to consider a moving average as a trailing stop. The idea is that a moving average crosses over price, then the trend is shifting. Trend traders would want to close out positions once the shift has occurred. So there's many different strategies we can employ. Okay. We always want to take a look at volatility. So using something like ATR and when the market volatility shifts. Okay. Because we always want to have an exit strategy. We don't want to run. We should never be running from the markets. We should never be being chased. but we should always have the strategy. Remember that Forex trading is more than just setting good entries, as a success for trading will ultimately depend on where traders exit their positions. New traders can build confidence in trading by having a trading plan that implements a precise exit strategy as to close out trades. Trading exit strategies are just one part of a complete Forex strategy. Price has an uncanny way of respecting not only pivot points but also Fibonacci ratios. Traders in highly liquid markets such as Forex use Fibonacci ratios to ascertain technical levels, which become effective stop levels to manage an open position. So once you have entered, the real trading begins. So do you know when to leave? So thank you very much for joining us today. Have a great trading day. And if you have any questions, go to www.legacyfx.com and they'll be more than glad to answer for them, or go to their education center. Thanks now.